It's Nick Ponty and Stephen Clark. Welcome to another episode of the Scottish Property Podcast. Well, this one's live, as I've just said. How you doing, Stephen?
Good, thanks, Nick. How are you?
Oh, good. We haven't had a catch-up for a while. The last time we sat down, had a wee catch-up in the market, what's going on, in our own investing, what's our thoughts in the market. It's probably back in around about kind of Christmas, beginning of New Year, so it's good to catch up with you.
Yeah, it has been a good few months, and there's so much happening, isn't there? There's so many changes going on, and scaremongering in the media. Interest rates are starting to be on the rise. Inflation's going through the roof. There's a war. We're coming out of a global pandemic. There's so much happening right now, isn't there?
Well, listen, I know you're not wanting to pay attention to what's going on in the newspapers and negative headlines and all that, which is fair enough, right? But there's no way of escaping this now, mate. You've escaped it too long. There's no way. You have to confront this face on.
I get my updates from you, mate, weekly on our podcast recordings before we go on. So you're my media outlet.
I mean, don't get me wrong, right? Like, I love your positivity and all that, and I see that a lot in the property world. People don't want to face like the kind of doom and gloom, which is all good. But I think that it's on everybody's mind now where the whole economy is going, because it did look quite positive for a while. Like coming out of COVID, there coming out of lockdowns, everyone's like, thank fuck we're going to get back on the road now. All businesses are opening back up. All the businesses that struggled over lockdown were now really busy. There was this whole pent-up demand. All the tradesmen and that were busy. And now it's like, oh, we're into a war, possibly World War III.
You knew that something was going to happen at the back end anyway. I mean, the government couldn't print out all the money they were printing out with their furlough and their bounce back loans and all the schemes and the money they pumped into the economy without having any kind of repercussions of it at the back end. Obviously, it's maybe been the catalyst is probably the Russian invasion in Ukraine. It's probably just causing even more issues of what's going on in the economy right now.
Aye, so today we want to get a wee chat about that. We're no experts, like we're no economists. We're not trying to claim to be experts. This is just our thoughts, our chat, what we're seeing in the property market, what we're seeing like in the economy, how it could affect us, how it could affect our tenants, how that could filter through eventually into how it's going to affect our property business and our property investing. So we want to get your comments.
Yeah.
Want to get your comments as well, guys. So
yeah, absolutely, and you're going to get the pessimistic and optimistic here on the call. So it's just our views on what we think is happening, and I think we should start on what's happening in the market. But I think because we both kind of keep our fingers so close to the pulse on what's happening in the sales market and the lettings market, kind of up and down the country, with even this network and the Scottish Property Podcast Facebook group page and the people on our network, you kind of get a feel for what's going on firsthand, don't you? And what are you seeing from the letting side in Glasgow?
Well, first of all, to start on the sales side of things, which we don't do estate agency, right? It's purely lettings that we focus on. But just Rightmove released their data, and because I'm one of the Rightmove customers, I get their data feed through, which is quite useful because it breaks it down into Scotland as well. And they release it every month, and they just said that things are still going crazy rates, and you're talking about the year-on-year figures are like 8% in Scotland. I think across the UK it's probably on average about 10% rises. So this is the weird thing. So that we're in this kind of weird phase where we're looking around us, and every newspaper, every news channel that you look at, with the war in Ukraine, with the rise in interest rates, with inflation, everything around about us is this like crazy, like the writing is on the wall for like some sort of mad crash or some sort of recession. But if you look at the property market where we're focused on, we're in this like bubble where nothing is affecting the property market, and it's still continuing to grow and grow and grow, and prices are still continuing to rise.
It is nuts, and I've been trying to hunt out someone, in my network that, as much as we both remember the last kind of crash, I think we were kind of too young and too early on in our investment journey to kind of take heed of what's going on now. So I've been trying to kind of find people to chat to that were very much aware and active in that time frame, because I bought 2006, refinanced, bought in 2008 before the crash. So then all I saw was the downside of it. But what I never really pay attention to, and I think the bit that we're in maybe now, is maybe the bit between 2006, 7 and 8 before it was a weighted crash. Like, the price, like new builds were going through the roof, and there were closing dates galore, and people are paying huge amount over the asking price for properties. I think we're in the same point again, but it'd be nice to speak to someone or have someone on the podcast that's like, been an investor for maybe 25, 30 years that can see that right on the wall, because history does repeat itself. These things all go in cycles that we've kind of seen time and time again.
Yeah, and I think when we sat down and did our catch up on the market chat right at the start of the year, I was feeling pretty positive about things. And I still do believe there's not going to be a property crash. I still honestly believe that prices will continue to rise this year. I mean, if you look at the fundamentals,
you've went from giving up on the below market value deals to buy at market value to fucking hell, I can't get market value properties. They're going for 15-20% over market value now.
If I get something for 15% over, mate, I'm happy. I'll take it. I'll pay you $2,000 for that. Like, no,
mate,
listen.
I'll find you deals like all day long.
See if you like put it down to the basic fundamental principles of what's driving the property market at the moment, right? Basic economics, supply and demand. There's still a huge imbalance. Now, take Aberdeen out of the equation, right? Because you're just in your own wee world up there, and we'll talk about that in a minute, right? But round about Central Belt, Glasgow, Edinburgh, Dundee, all the rest of it, there's still a shortage of supply coming on the market, and there's still a huge demand because of we're still in relatively cheap credit, right? So mortgages are still cheap. Although we hear this, interest rates doubling, like they've doubled from 0.1%, right? Now they're up at 0.75%. So they've actually, if you break that down, what's that, like a quadruple, probably more. Do you know what I mean?
We've went up seven times and it still doesn't really affect it, does it?
So at the moment, right, as we speak, we're still in this cheap lending, which, if you look back 2008, that's when the crash did happen, when there was no lending. Like, that's when things really started getting bad. So we've still got the cheap lending, which is obviously causing the big demand because we've got hedge against inflation, which from other investors piling into the market as well. We've got this. John Morrison says there's too much QE money sloshing about. There was this huge injection of money through loans and furlough and all the rest of it. This massive injection over COVID, which is still, like John said, swirling about in the system, which people have got deposits. And then on the supply side, there's definitely still a shortage of stock coming on the market. This is what you hear from estate agents all the time. People probably still a bit reluctant to move because of the times of uncertain times because of COVID. Now we've got the war, people are just a bit maybe sitting tight still. So for me, that's not going to solve overnight.
We've still not got the repossessions coming through as well yet because the money that was kind of pumped into the economy. So we've not got that market coming back in yet. But I mean, that will come back in, and rising cost of living and rising interest rates will kind of force that a little bit as well.
So yeah, so at the moment there's the huge supply and demand imbalance, which I don't see going away. So my prediction is still that the property prices will still continue to rise this year, but not at the rate that we've seen. So the 8 to 10%, I think, will drop down to the 4 to 5%, which I think is still what I said at the start of the year. The only thing, obviously, that's happened since is the war in Ukraine, and obviously how that's going to filter through to the inflation that was already.
I'm thinking about the property prices. Just sorry to interrupt you there, Nick. That all I'm hearing, and you were kind of saying the same, is the Dunfermline market. I mean, I'm hearing there's estate agents and obviously people doing deals with my mastermind group up and down the country. So I'm kind of seeing it from most major towns and cities in Scotland, and they're pretty much the same boat. But what kind of is making my mind think on it is if a property goes on the market for 200 grand and it goes 15-20% over and it goes for 240 grand, the next time the surveyor goes out to do the home report for a similar property in that area, it's now the valuation is now 240 grand. It's went up 20%. So if people are getting told by estate agents that and the kind of common theme in the marketplace is to stand a chance to get this property, you have to go 10%, 15% above the asking price. What's that now going to? You've went from now 200 to 240, and now some have to go and offer an extra 24 grand on top of it to stand a chance again. And you're seeing a huge sharp rise, not just a small rise. They seem to be sharp. Like I heard the one yesterday that went on the market for 220 grand. A friend of mine offered thinking they'd get for 250, went for 279, a 3-bed detached house in Dunfermline. Like they're going silly over. Like 25, 30% over. And the way I look at it is, an estate agents go do the exact same due diligence as we're going to do when we're buying, is look at the end values, and the end values is clearly what people are paying for it, and people are paying that inflated price. So is that resetting the price to then, do you know what I mean, go again for people to pay that bit more over again?
Yeah, and how far can that continue to go? Till it
Was that
gets.
not, is that not what happened when you bought your one in Inverness back with 2004, 2005? When you bought it, did you not fucking get a huge amount of increase in a short period of time? Were people paying a lot over the asking price for that property when you sold it on?
Yeah, well, what you got to think there is like, wages, basically, wages are not keeping up, and people's salaries are not keeping up with that increased growth as well. So, if
Mm-hmm.
things are going, like you say, 15 to 20% over, and then they continue, and then that sets the price, that sets the market value for the next sale, then, that can't continue very long, let's face it.
Is that not where a crash comes from, where the bubble pops?
Well, yeah, but I just,
But
again,
I get your point with the supply and demand. If the supply is not there and the demand is there, then people are going to pay that premium for it continually for something they want.
we're getting some comments coming through. This is good. Right, I'm going to stick this one up here for you. Wait a minute. Barry Gray. Stephen, are you regretting buying a new car with the cost of fuel increase? So just tell all the listeners, mate, what's your new car?
I knew you were going to freaking mention it.
He doesn't like to
I,
show off, but he's joined one of these members clubs where they go about and roll about in their fancy motors at the weekend and stuff like that.
with the hats and the jackets with the branded the car brand. Yeah, I'm going to be one of their wankers.
Well, let's talk about the cost of living crisis, and what, if effectively, what is going to put a slowdown on this market. Do you know what I mean? There could be a few factors at play here, right? So the cost of
Yeah,
living crisis. So we're all reading about rising energy prices from the 1st of April. I think your average bill is going up 54% or something like that with the new cap increase. So that's energy prices. That's just April, by the way. They're talking about another rise in October coming. So that's going to have a huge effect. I don't think people realize how bad that's going to affect a lot of people, like we were talking earlier, maybe not you and me, who are like in quite a fortunate position, but plenty of people just live.
yeah. I think minimum wage incomes, lower income households, incomes whether we may just working part time or, I think that's hugely going to affect these people and these households. But that might not be, like you say, us directly, but it's certainly going to affect our tenants, our tenant demographics.
Well, not even just people that are on minimum wage. People that are on an average salary who maybe looking for, as a first time buyer, so
Yeah.
25 grand a year or something like that. I mean,
My optimistic view on all these kind of things. Like, I just think it's in proportion. I mean, I've not been looking at the headlines. I always just think it's scaremongering bullshit in the media. Okay, there's some reality in it, but I think people don't need to break it down and take an action on what's happening. So, just say, for instance, you said 40% increase in energy prices. Just say that's your electricity cost. No, I'm completely spitballing here. If you pay £200 a month on electricity and your salary is £2,000 a month, you're only spending 10% of your income on electricity. So if it goes up 40%, it's not the biggest hit in the world. Whereas if you combat it and says, do you know what, okay, I'm going to fix my mortgage term for 5 years and now before the interest rates rise up and then we get wage rises, so I'm actually better off per month. But people didn't like, Matt, I hope my in-laws are not listening to this, but my in-laws were right on the panic. Like my father-in-law has not been sleeping because of the news, and they get 3 takeaways a week, and you're at 20 quid a pop, and I'm just thinking, just cut down on one takeaway, 20 quid a week. There's 80 quid a month saved. Like, done. Your energy price is gone. Like, your issue that you're not sleeping at night is gone. Like, you can make small little adjustments or tweaks or plan for it without listening to the scaremongering and then following what I think would put us into a bad position and could cause the crash. Because if everyone sees all these daft energy prices up 50%, what's going to happen? They're going to start demanding flipping wage rise 10%, 20%, 50%, and that's when you're going to get a crash in the economy because you can't sustain that.
No, that's good. That's good thoughts, because like there is that whole thing about market sentiment, isn't there, and public sentiment. So where they get that from is opinion, reading in the news. So if people are looking at all this doom and gloom and all the rest of it, they're going to say, no, I'm not moving, or I will, like, I need to sell my house now because things are going to crash. It's going to affect their decisions.
Aye. People are influenced by these decisions, and rather than actually looking at the facts and figures of it, they kind of start making decisions based on emotion and what the common theme is that's out there. And out there is doom and gloom, isn't it? It's huge inflation costs, it's rising costs. But when you actually break that down, like that's what I'm saying, like a tank of fuel are going up by what's petrol went up 20%. It just doesn't make a huge difference to your actual income when you actually break that down.
So you mean to say you're not listening to Martin Lewis and reading the Daily Mail, mate? Come on.
I was getting that chat this morning in the gym on Martin Lewis saying that we're all doomed and he actually can't help us and stuff like that. I was like, shit.
No. See, Martin Lewis, right? It's going to be the worst poverty crisis ever in history. Like, look, it could be bad, right? Because not only have you got rising energy prices, you've actually got rising fuel prices, which you're well aware of, mate. I know you've got an electric car as well, but he's just gone and bought a Porsche. I was asking him earlier on about this Porsche and saying, how much does that cost to fill up? But it's not that much, is it?
No, it was only 70 quid to fill up. But I'm only taking it out of the weekends and I can offset with my electricity savings during the, well, I maybe could have offset that with my electricity savings during the week using the Tesla, but if they're rising through the roof, I think there's some sort of alternative plan for that.
It's only,
my missus bitched more about that as well. She was on my case about this. Like, right, you've got the hot tub plugged in, and you've got the Tesla plugged in. We're going to have to go and switch the hot tub off. And I was like, chill out. Like, really, chill out. You're not unplugging my Tesla, all right? But she's got one of these schemes at work where you pay a £10 a year and you can charge for free on their electric charging points. So I said to her, well, you take my car in one day a week and charge it for free and don't have to use the house. Like, it's just simple things like that. If that was the worry, just, make a plan, make a plan attack to combat it rather than fucking getting on the train and the doom and gloom and letting that affect your decisions.
So it only costs him £70 to fill up his tank, but he only gets 20 miles down the road, then he has to fill it up again. Barry Gray's like £70 for half a tank in my diesel. Aye, so you've obviously got a gas guzzler as well, Barry. Right, Rosalind's jumped in here with a comment. She's got a very valid comment. There's not only rising energy prices, rising fuel costs, there's the increase in national insurance contributions as well, which is going to hit a lot of families hard. A lot of people who are just on the PAYE, not like us in business, but we'll get to that in a second because business owners, obviously, dividend tax is going up, corporation tax is going up.
Corporation tax.
No matter where you look, taxes are going up as well. So, again, it's going to have a squeeze on people. I don't know about Martin Lewis's headline about, the worst poverty crisis in years, but it is definitely people are going to feel. And, you know what? Like you say, Stephen, there is a lot to on what you say in terms of, don't go and buy the Starbucks every day or don't go and get 3 takeaways every week and stuff like that. Do you know what I mean? I think people are just going to have to.
But that might affect the economy as well if people are not spending, the spending habits are out there as well. I get that, but then is that not the type of? We just looked up the inflation records there before we came on the call to check on it, and I think the last time we saw inflation numbers like we're away to hit just now was the early 90s. But then we did, on the counter of that, we looked up the interest rates, and the interest rates were at 13, 14%. We're at 0.75. Like, yeah.
Yeah, well, I mean, inflation rate, which is the CPI, Consumer Price Index. By the way, I've been really geeking out on all this stuff lately, mate. I mean, I actually quite enjoy learning about it. I enjoy learning, and this is a whole thing about the economy. It's all new to me, but so Consumer Price Index, which is like a load of stuff they stick in they call it a basket of goods, and then they take all the kind of cost increases, and then at the moment it's 5.5%. We looked back in 1990, it was 8%. So this is the highest in 30 years, I think the headline was, in terms of the inflation rate. There's talk now, Bank of England, initially, right, the Bank of England came out and said, oh yeah, this inflation, it's all going to be transitory. Another word that I had to Google and find out what it meant.
What does that mean?
So basically, they said that the inflation was going to be short term, and it was all because of the supply chain bottleneck, supply issues, come from China, all this kind of slowed down production, basically halting production, and the supply chain was catching up. And after the COVID pandemic and all things eased off with lockdowns, etc., things were going to return to very quickly. They said that it was going to return to kind of normal inflation. And for them, they try and target inflation at 2%, right? So that's their target. The Bank of England's target is 2%. And then they use like monetary policy, which is basically rising interest rates to try and adjust it, to try and bring it down, right? That's their tool. That's their leverage. Now we're running at 5.5% CPI. In the States, I think it's possibly like 7% or something like that, crazy. I hope I've got those figures right, by the way, because it just every month it keeps changing. So if I'm wrong in the figures, guys, just tell me in the comments. And then there's talk of it now going up to, people thought it would peak at like 8%, possibly 7%, sorry, pre the war. Now they're talking about it going into double digits, like 10% inflation. Now we looked back, and the highest point in 1990 there was 8%, and that's when the interest rates went up to 13.8% base rate. That's not your mortgage rates. That's the Bank of England base rates. Now, usually on top of that, they add on a couple of percent, as we know, with the mortgage lenders. The good thing is that mortgage lenders and banks are in a very good position. They've got money to lend, plenty of money to lend. They're in pretty good condition, and the competition between lenders is pretty fierce. So, although fixed term interest rates are notching up a little bit in terms of the lenders and the mortgage providers, they're not really going crazy. They still seem to try to keep them down, as far as what I can see.
Yeah, I think the only thing I can add to that as well is I've noticed that lenders are kind of tightening their belts a little bit. They're being a bit more diligent. They're asking for a lot more information, taking a bit longer to get back to you, being a bit more pernickety with cases, stuff like that. So, don't know, is that a sign of the times that the lenders are getting a bit twitchy, banks are getting a bit twitchy with what's going on?
I mean, how has it changed your investing goals, your investing strategy? Because it's not, if anything, I'm trying to buy quicker at the moment, because I'm trying to, I've got a little bit of cash in the bank, so I don't want that devaluing with inflation going up, right? Because if you've got cash, inflation's going up at high rate, that's not good for your savings, It's not, you want to get that into assets. So for me, I'm trying to just buy quicker.
Mm-hmm.
How about you?
I like what you said there as well. Like, you love this whole educational period and trying to learn more about the economy. And I am enjoying that, and I'm enjoying this chat as well, because I think it is good for growth. I don't want to dwell on it. I want to try and make educated decisions on it. But I think you saying that kind of hit the nail on the head even more so. It's probably more important to have a better network of people around you that are having these conversations and doing more education, buying right. I think I'd be strict. I'd be strict with my criteria now. But on the last year, I've been quite stringent when it comes to flips. But I'd probably let go of that, because you're always basing your numbers on what the end value is going to be. But we know that they're pretty much going for 20% more than that. So if that's your profit margin, you can go that bit extra 20% over to try and get the property. And this is where you can get opportunities in rising markets, hot markets like this as well. But I think it's conscious of making the right move, making the right decision, and trying to get a bit of education and trying to have a bit of strategy for it as well, rather than just going out there based not on emotion and buying because we think it's going to go up another 20% this year, or because of media headlines.
I've put it out there. I'll quite happily buy in Glasgow at home report value if I can get them in decent areas and decent buildings and stuff like that. So if any sources are out there that have got anything, then please come to myself, because I'll quite happily pay you, even if it's on Rightmove and it's on the market. I'll happily pay you £1,000 for something that's on the home report.
Just £1,000
on the Rightmove, on the market. If it's off market, I'll pay you more than that, obviously.
Do you know what? It must be a bit of a sorcerer's dream at the moment, because there is probably a lot of investors like you that are sitting a bit of cash sitting there going, do you know what? I am need to buy something. I can't have this money sitting in the bank. It's better getting parked into some kind of bricks and mortar that is going up in value. And these, that's on the market. Yes, is difficult to find, but off the market, you're finding deals easy off the market because they're not aware of the kind of market conditions. They're not the vendors not broached the conversation with the estate agent to understand how hot the market is. So they're coming here with expectation, which is usually a lot lower, which you still manage to get deals. So it should be quite a good time for sourcers as well to
I don't know,
pass on
mate. See
deals.
what you're saying about off market, right? I'm speaking to sourcers out there, and they're even saying like the off market leads that they're getting because people are reading the news, so they're seeing day in, day out, property prices are breaking records each month. Do you know what I mean? So that people are no daft. Do you know what I mean? It's hard to get off market deals as well.
Yeah, but I mean, your off-market deals don't have to be as hugely discounted as they were before. They don't have to be 30% below market value because of the price, like the rising costs, the rising property prices.
Absolutely. If you're a sourcer and you can negotiate a genuine, I'm not talking about just off the home report. I'm talking about a genuine, even if it's like you say, 5% to 10%. There's a decent fee in there. Do you know what I mean? Because investors like myself who are going out and doing viewings, like I maybe line up 8 viewings in the week, I'll maybe offer on 4. That for me is a huge time sucker. Do you know what I mean? So if somebody can even just save me a couple of £1,000, I'll pay them a fee, or else, it's time for me at the end of the day.
It's a time-consuming exercise with not much return if you're playing in the market and there's 30, 40 other people doing exactly the same and you're going to go to closing dates, then it's probably how efficient you could be using your time.
Yeah, we should build up like an army of sourcers with the Scottish Property Podcast, because like me, myself, obviously, a lot of my clients as well, my landlord clients through the letting agency as well, they're all wanting to buy too, because everybody's just like, God, because rents are on the increase as well. So this is how, I love the property market as well, because
let me ask you a question that I'm always quite keen on hearing from other investors. In a rising market like you're facing right now, would you refinance your properties to pull more equity out of them to reinvest and grow that portfolio right now, or would you keep that loan to value quite low?
See, again, this is not financial advice, right? This is what I would do, right? This is what I want to do. So I'm trying to, basically with the equity, I've got quite a bit of equity in my properties now, and I do want to leverage. I do want to, while it's still cheap, get those fixed rates tie-ins for 5 years, leverage that money and buy more. I'm wanting to buy more just now because I do believe that still over the next 2-3 years, I still expect prices to increase. I don't expect a crash. I expect a slowdown in the property market purely because of that lack of supply and the supply demand imbalance. So I'm still buying it, and I'm still buying for my long-term goal, which is 20 properties by the time I'm 45 and 42 at the moment. So
I remember, I'm always interested to ask it because I remember obviously the crash in 2008, but more recently with the stuff I'm buying in Aberdeen, I still find a lot of times, like I've just appraised a portfolio literally yesterday, and the guy's bought a 1-bedroom flat in the block next door to the one that we've just bought on Union Grove, and his mortgage amounts at 105 grand, 108 grand for this 1-bed flat. We just bought one for 49 grand. So he's leveraged as the markets went hot. It was worth 135, 140 grand, leveraged to over 100 grand, and we're buying them for 50 grand. So it always makes me very dubious. Like when I feel like I've got my money back out on one refinance, I'd try and get that loan to value down by either the capital appreciation or paying down debt. It always makes me nervous when you see a rising price, a rising market, and people then pull more out to then go again and think, shit, what was in the market prices? Now I get your sentiment. If they go up 10% again this year and next year, you're up 20, 30% in a couple of years. And if it does dip, then chances of going that low that it might go back to where you bought it. But it depends on how you time the market.
I just believe if you're tying yourself in for long-term fixed rate mortgages, right, for 5 years, then, like you say, even if there's a crash, say there's a crash this year or next year, if you're buying in good quality areas round about Glasgow, which I do, I just don't just buy any old crap in any old wee town or village. Do you know what I mean? It's got to be in an area high demand, which that is going to obviously rebound quicker in a market that will drop, but it won't drop as hard as it will in the areas which are kind of, I don't know, like You always talk about an example up in Fife. You always give that wee town a hard time. What's the name of that wee town up with you?
Oh, methyl.
Aye, methyl. So if you buy metal or methyl?
Methyl.
Right, methyl. Let's just pick on methyl, right?
I'm gonna get the hate train now.
So if you're going to buy in methyl, right? So that's the areas that are going to come down hard and fast, right? They're going to take a heck of a long time to recover. Possibly they've not even recovered from pre-2008.
I think they're maybe just getting there now. Yeah, you're right.
Just getting there now, right? But like the areas like that I buy in and good quality, high demand areas for rental and for sale and for first time buyers, these are the areas that might drop. What's could happen in a crash, right? Drop like let's say last crash they dropped, what was it, 20% or something like that, right? Over the next, if you're locking yourself in for a 5-year fixed term, hopefully, if it crashes, it'll be quite. What if it's quick and it crashes for a year, right? Then you've got 3-4 years to recover from that and try and come back up. Obviously, that's my thinking.
I agree completely with the buying the high end stock, and I've got a little plan with this kind of crash, but I don't want to be one of the ones that sit on the fence. And I've slagged you off for the last couple of years doing the podcast, sitting on the fence, and I wouldn't want to be like, oh, let's sit on the fence, wait for the crash coming. Like you say, it goes up another 20-30%. You're like, fuck, you could have bought in, and like you say, if you're in for the long term, then it's going to work its way out. But for me, I'd much like the assets that are around where I'm staying at the moment. Your new build estates and your 4 and 5 bed detached houses. I want to buy them. I'm kind of at the stage of my portfolio now where I'm happy with where it's at. But and it goes again, I like to buy really, really quality assets. Like the people that are going to, there's going to be an affordability issue for people trying to get on the property ladder. They might not want to, take their family into something they can afford. They might just go and rent, but they'll have to go and rent somewhere that in the same area. But these are the type of tenants that will probably be in your property for life. And good cash flow, good, like you say, they'll bounce back very quickly because they're in really, really good affluent areas. I'd much better buy quality stock as well. And I think you're right. I think in crashes, they don't get hit as heavy and they recover quicker as well. Whereas, yeah.
Barry Gray's put a wee comment on here. If you don't plan on selling, there is no issue with negative equity as long as you keep the tenants paying your mortgage. Well, but that's a good point, Barry. But how far will interest rates go? And how far can we, again, we're talking about, nobody knows, right? People think, right, there's this whole thing where the Bank of England are in a very difficult position because they don't want to raise interest rates too high and fast because they don't want to stunt the growth of the economy, because we're coming out of this post-pandemic stage where we need to recover from all that as well. And then we've hit the war, and then all this inflation that's going to rocket now with the basically rising all the stuff that we just mentioned. The government are not wanting to ramp up the interest rates too hard and too fast because they don't want to stunt all that growth and send us into a recession, because that could send us into the recession, because then you're cutting people's spending, they're not lending, all the rest of it. People are holding on to their money, which obviously has that effect. But how far can interest rates go until it becomes a point where your buy-to-let property is no longer making any money? Do you know what I mean? So I think we could probably, most people are saying it's going to be like 2% by the end of the year, right? Which could filter through to like a sort of, say, a 4.5% on your lender's fee, on what the mortgage companies are offering. So at the moment, it's 0.75% is the Bank of England base rate. Most lenders are offering deals for buy-to-let company deals for about, 3.5, 3.6.
I just got one at 3.18 there, yeah.
Do you know what I mean? So there's quite a bit of difference there. So say your mortgage line is going to be 4.55% for new mortgages. Then you need to start maybe raising your stress test calculations and stuff like that, and really making sure that rent is going to cover. The good news is rents are rising as well. So we put on a property there just recently. Same property was on the market last year. This year it's £100 more in rent. Do you know what I mean? It's gone up crazy amounts.
I think to touch on Barry's point there and what we were just chatting about kind of quality stock, you don't know what position you're going to be in as your portfolio grows. Now, it's starting off, and this is probably the word of warning I'd maybe give people starting out as well, is maybe don't jump on the bandwagon and buy shitty low hanging fruit stock, because it's all good and you think they're the deals at the start when you're kind of starting out. But there's a couple of flats in my portfolio that, as the market's ridiculous, I'm wanting to get rid of. And yeah, I probably would have bought that. I bought the money back out them 6-7 years ago when I bought them. But they're shitty flats with shitty tenant demographics and shitty areas. And when they crash, I probably won't be able to sell them for 10, 15 years again. Like, it's at a hot market where I could exit them. I can get some money back out. But I think for me I think it's quantity over quality when you kind of grow a portfolio. I think you'd be the same. Like, you maybe started out and buying stuff that you can afford, and then as you kind of learn and grow, and you realise that, no, do you know what, I'm going to go for a house rather than a 1-bed flat. You start to kind of realise, oh, do you know what, that's becoming, and especially when you start putting them in your spreadsheet or your profit and loss and looking at each investment individually in your portfolio and going, do you know what, that gives me the least amount of cash, so the most amount of headaches. The tenant never pays. There's always an issue with maintenance. They always trash it. There's a bit of void. When you plug that over a long period of time, it's got to stack up. Now, yes, the rest of the portfolio can substitute that property, but if it isn't performing right, sell it. And that's the kind of probably the warning I'd do to the guys starting out is maybe don't just jump on the low hanging stuff at the moment, because you might, in 5, 6, 7 years time, you might want to get rid of them, go and get an absolute nightmare property, and you could be in negative equity then.
And that is the temptation, because while we're finding it really difficult to find those deals in those really popular areas, there's that ripple effect. So people are going out into the satellite towns around where I am in Glasgow. They're going out into, for example, Paisley, which I regard as a really good investment area if you're buying in the right places. Even that has got like crazy amount of buyer activity at the moment, because all the investors are piling in there, because it's a little bit less competition, but it's still competitive. I went for one the other day, straight away, closing day after the first viewing, probably 7 or 8 people offering. So the likes of that, people are starting to get desperate and spreading out, and that's really good advice, Stephen. Couple more comments here on LinkedIn. So we've got Barry Gray here. He says, just wait for the 18-year cycle to come back around again. Barry, if it was that easy, only we could predict it to the 18-year property cycle. I don't think the 18-year property cycle predicted a global pandemic and World War III. That's the only thing I would say to that.
That's never the same thing that causes the crashes, or the rises. There's always something. But Barry's spawn, like, if you actually look back on it, it does kind of time that 18-year cycle. It's just trying to figure out what point you're in and how long that point lasts for. But
don't get me wrong. I mean, obviously, like, I'm just having a wee joke there, Barry. The 18-year property cycle, look back in history, it does obviously play out. It will play out. And like you say, it's just that trigger. What is the trigger? This time, it's probably going to be the rise in interest rates and the squeeze on people's, the squeeze in the cost of living, which is going to reduce that disposable income, which then they won't have deposits for, to buy their mortgages and house moves and stuff like that. They're going to be squeezed to the point where they can't move house. They're going to be stuck,
I think we had a conversation on a previous podcast trying to figure out where we were in the 18-year property cycle, and we thought that if you were timing the crash, it'd come about 2025, and obviously this was this pre-war. You sound like you're still kind of sticking to the same opinion.
You talking to me?
Yes, I was. You're the only one I'm speaking to.
Sorry, mate. I was reading the comments here, because there's some right good comments coming through. There's one from Jennifer Murphy. Hi, Jennifer. If you have equity, refinance and pull equity out, and then sit and wait and the price is falling, that's all well and good, and that's what I'm doing. Now, some people say, what, have you not learned anything from 2008, where people were over leveraging, and that's the whole reason that the banks got into such a disaster? I think it's a little bit different this time. I think banks have got a bit more of a hand on it this time, and they're not getting too greedy. So I don't think there's going to be that.
You might not necessarily need to refinance. Like, I know I'm selling, the ones in my own personal name, so people getting bought in a limited company, but it's the same thing. It's just trying to be as liquid as you can. Selling off some assets, but the ones you maybe don't want that aren't performing well in the portfolio. The market's ridiculously hot. Sell it at a premium right now, and like Jennifer saying, wait for the sit tight, wait for the prices falling, bubble pot falling, and pick up some good deals. But when I thought about this the other day, and it's probably going more towards your side, Nick, that I think the timing on waiting is probably not the best idea as well. Because if you think about the 2008 crash, when was the best time to pick up deals? When you look back on it, it was like 2012, maybe 13. That's 4 or 5 years after the crash. So it's not like you're going to need to be sitting there with the cash ready to go and jump on a deal. Like, it's going to take a bit of time, and it'll have be conversations like these for probably a couple of years, watching the economy and watching prices come down. But like you say, if you're in it for the long term strategy, you're going to do well out of property.
Let's just touch on Aberdeen for a wee while, because I know you're still investing in Aberdeen, Stephen, and that's where all your bulkier portfolio is. So, let's talk about. I was always one for staying away from Aberdeen, just because I thought, you know what, everywhere else in the country, the property prices are rising, bar Aberdeen. That was my whole thought. I was like, why would I want to invest there? But like you say, if you get it when it's low, then that's obviously where you're going to make money. But recently, I have kind of changed my view on it slightly because of this whole war. Basically, there's this whole thing now where the government are trying to become less reliant on global imports for things like oil and stuff like that. So they've now
own huge reserves, yeah.
Yeah, so basically they've now said that they're looking to give out more licenses in the North Sea oil. So that whole thing was pretty much shutting down in terms of oil. They weren't giving out any more licenses in the oil field, and we were going to this whole renewables. Now they've kind of backtracked, and now I think that all that kind of industry now up in Aberdeen, I think could really flourish now. And I think, well, they were already on a good thing, I think, with the renewables. I think they just had to push that hard with the wind turbines and all the rest of it. But I think now Aberdeen's looking good for you, in my opinion.
Yep, I'm going to be honest, and I told you so. Even going back to my point there with the kind of 2008 crash, and the best time to buy it was like 4 or 5 years later. It's the prices, the property prices followed the oil price crash in 2015-16. So we are 6-7 years on from that now. But the last few months, I've already noticed the tide's kind of changing. The rental prices have been creeping up quite significantly. They're not been going down the way, trying to get some tenants in it. The demand's starting to come down. Now, obviously, it's nowhere near like what you're talking about. But we noticed that Chris Minchin pulled the stats for us for our last Scottish Property Podcast Network event in Aberdeen, and there was 130 properties less on the open market for rent than there was in February. So it's the supply is starting to come down, and I think he done a statistic on the viewings that his agency had booked in as well, and they were the highest they've been in the last 5 or 6 years as well. So the demand's starting to come up as well. So hopefully that does lend some positive news for Aberdeen that's starting to go on the climb.
Right, guys, we'll probably just wrap it up here shortly. So just a last couple of comments here. So Barry Gray, again, thanks very much for all your comments, Barry. You've been great, giving us something to talk about here. So he's buying the crap towards the bottom end of the market. You can always fall back on the local housing, LHA rates, people on universal credit and all that. If you're stuck with these properties, I guess that all basically boils down to your whole strategy. Are you looking for a bit of capital growth, long-term capital growth, or are you purely focused on just the cash flow figures and buying towards the low end of the market and presuming that you're just looking for more of the kind of cash flow? So that can certainly work as well. And there was just one more there. Diversify. Jennifer Murphy, diversifying in the meantime, lads. I think it's a really good point. It's something that's been coming into my head lately.
I just funny enough, she says that is absolutely what's been on my mind. But we've been like trying to be liquid, raise cash, sell the assets off that you don't want. But one thing I did do is I found a tenant for my commercial property, and when I found the tenant, they then wanted to buy it, and I could have took a quick win, a quick cash sale, but I'm thinking just keep this return, because when I actually look at the return on the commercial project and property and tie them into a 5-year fix, then the return's phenomenally well. It's a really great cash flow and asset for the price that I bought it for. So yeah, I absolutely agree with that, Jennifer. Diversify as much as you can.
And I keep sitting on the fence with Bitcoin and crypto. I really, really want to do it, but I just don't know. I just haven't pulled the trigger on it. So I think there's people out there. It's volatile. It's really, I think, again, it's a long-term play. It's really up and down. I just can't see. I can just never see past property. That's my problem. Whenever anybody mentions another investment to me, stocks and shares, crypto, all the rest of it, I just go, well, I can leverage. The thing I love about property is I can leverage it to, I can buy a property worth £100,000. and I'm only putting £25,000 in, but I'll make 10% a year on that 100,000. And you can't do that with any other asset class. That's why I just love property so much. On that note, Stephen Clark, where can people get their tickets for the upcoming Scottish Property Podcast live networking events?
Yeah, jump on Eventbrite and type in the area you want to go to. We've got Glasgow's sold out, as always. A week or two before the event, it always sells out. You've still got tickets available for Aberdeen, Edinburgh, and Dundee. With some fantastic guest speakers lined up as well on all these events, so it's going to be good.
Yeah, we're absolutely loving the networking, guys. Want to really keep pushing that. So if you know anybody who's interested in property as well, get them along. It's a real mixed bag in the room. It's not just for kind of like experienced investors. We've got loads of young people that come along to Glasgow, and it's great to see. There was one guy reached out to me on Instagram. He was only 15. Bless him. And he was like,
that's the guy I'm going to pick up and take him along to the event.
Yeah. He was like, I'm really interested in property. I'm just worried that I'll not be old enough if I go and buy a ticket to get in. So I'm like, no, absolutely. You are welcome. So all experience, all age groups.
It is so good to see the same faces that are kind of popping back every month as well now. So you're actually starting to build a relationship up with the people rather than just meeting them, once or twice. Like, it's good to see them returning and volunteer to share some information as well. Like we do a case study from the city every month as well. So you're getting people kind of volunteering and offering to share their kind of knowledge, experience, and what they've kind of found as well, and lessons learned, wins. So it's really, really good, and people are so open to it. So if you're interested, no matter what level you're at or where you're at in your property journey, jump along and meet some like-minded people.
That's great, guys. Thanks everybody for listening. Thanks for all your comments, and we'll speak to you again next week.
Thanks a lot, guys.